opportunity to speak. And 1 year on since I did the presentation last year, and not much has changed, but a lot has changed. So it's a very interesting time, and I'm sure we're hoping that this year is going to be a lot better. So as Tony said, today's presentation, I'm just going to cover, a bit like last year, I'm going to look at the macro environment, dig down national, dig down to the state environment, and kind of focus on the past year, some of the economic indicators and what's been going on. Now, as I always say, most people have read some of this or heard some of these stories before in the news and everything. What I've tried to do is just capture kind of some of these stories going around and bring it all together, so you can have it all in one spot, I guess. And then we end with some, I don't know about a crystal ball, but we end up with some of the lingering questions about the economic outlook for the future that might be of interest to people. So I'll jump into it. I'll share my screen. I'm assuming most people can see that. You know, I'm an economist and, you know, you're a finance professional, so there are a lot of charts today and everything. I think the usual standard is I'll kind of speak for about 30 minutes or so, and then we'll have questions after that. And I'll try not to be too chart heavy, but there is lots of charts and everything, but they're also key points. So I've titled this COVID Recovery 2.0 because we were looking at a recovery phase probably around this time last year, actually. We're getting optimistic about the vaccinations and everything. And then we went into lockdown mid last year, and then had a semi-recovery, and then Omicron hit. And now we're hoping, so this could even be recovery 3.0 titled, but there's been quite a few. So today, as I said, we've got the global outlook, bit of a national picture, and the state focus, and looking forward. Globally, well, it's mixed fortunes right across the world. If you've been following the news, America is well above pre-COVID levels. So their economy has actually been going pretty much gangbusters. Especially the second half of last year. Lots of consumer spending, breeding into confidence, and that's driving into prices as well. We'll touch on inflation in a slide to come, but America is charging forward there. Omicron kind of slowed it down a bit, but I think whether people were over lockdowns or there was less lockdowns, less restrictions in the past, so spending levels kept up quite a bit. China has been above pre-COVID levels for some time actually, but they've been, in contrast to places like America and the UK, they persisted with kind of a zero COVID kind of policies. So they had very strong lockdowns, but their lockdowns, obviously, they can enforce them a lot harder. So the lockdowns kept the COVID out and enabled the economy to return to what it was pre-COVID levels, although there has been some kind of slowing, and most of their economy has been growing based on exports. Less on consumption. So there is still some wariness around, and there's, you know, long-term or medium-term, they want to transition more to domestic consumption driving the economy and not just relying on exports. Brazil's bounced back above pre-COVID. France, in the last quarter, saw it back and had the strongest growth of the quarter for 52 years, which is, people say, you know, probably going into an election year, I think, over there. UK just got it back above pre-COVID, but that was just prior to the Omicron, so whether it dropped back down. Japan, slowly recovering and almost back to level. So these are the top economies I'm running through here. Germany was still below pre-COVID, and along with Spain, they're the two big economies that are kind of been lagging other regions in Europe. Germany has, well, had about a 66% vaccination rate, so they still had a number of lockdowns and restrictions across different districts across their country towards the end of last year, which saw the economy lag. And India and a number of developing countries are still facing health issues, are still well below pre-COVID levels there. Meanwhile, Australia, well, on an annual basis, if you take an annual sum of our GDP, we were back above pre-COVID levels at mid-June. On a quarterly basis, we were back above it in March, but then September's was below what we were pre-COVID. Now, when I say we're back to pre-COVID levels for all these countries, for most of them, it's back to the GDP levels that we had pre-COVID. So we're not back to the pre-growth rates just yet, because there's been a lot of bouncing around. in movements there. Except for United States, their growth has been so strong, they're probably going to overshoot possibly their pre-COVID growth levels, which will be interesting. So the other big thing there on the world stage is global forecasts have been downgraded slightly. So this is from the IMF, and we saw here, so these are the forecasts that were done in January last year, then they did them in April, October, and then January, the most recent one here. And their forecast for 2021 actually improved as the year went on, and as economies came out of restrictions and the vaccine rollout went better than expected in advanced countries here. But their forecast for 2022 actually, it increased as the year went on, but then it dipped in the most recent one, and that was to do with Omicron coming back and causing some, labour shortages, and there's also some inflationary pressures which affect. So their forecast dipped away a bit for 2022. The outlook for 2023 is even much lower. Okay, so you typically get high, obviously, economic growth rates when you're in recovery mode, and they're forecasting that a lot of the recovery mode will happen this year, and then we'll return to kind of slower growth rates. So the world was moving to slower growth levels prior to COVID hitting anyway. If we look at inflation now, so you might have seen this in a number of, I'm just going to move my newspapers here. So Europe, 5.1% year on year to January. US hit 7.5%, the steepest since, 40 years, basically. In Europe, the big one there we can see is energy, basically. Energy prices went up 28.6% and really drove most of that price increases. Natural gas prices were incredibly high, and we had lower supplies coming through from Russia. In the US, it was a mixed bag. So we had that energy was still increased, but you also had lots, as I said, consumer spending actually, and supply shortages driving up prices. So it wasn't just energy. So it was more of a mixture of the United States in contrast to Europe. Some relief in sight. Another thing you might have picked up on, there's a lot of talk about the freight costs, and there was a slight relief in the last couple of months of 2021 as prices for international shipping of freight started to drop down, but you can see it's got a long way to go. This is an example here. It's a long way to go back to what it actually was. And it was driven up by a multitude of different things. There was a massively increased demand for shipping products, basically. A lot of people shifted their consumption to products away from services, naturally during restrictions, and therefore there's a global demand for products, and shipping hadn't caught up. And it's starting, supply chains are starting to catch up now. There was also a kind of a hoarding of freight space as well, but some of those problems are starting to resolve, but there's still a shortage of certain areas. Mentioned there the shortage of computer chips. We're going to take a couple of years to be resolved, and that flows through to the extra costs, which have been passed on to the consumer in some regards. Nationally, this is so the latest data from ABS is up to September. I think we'll get in a couple of months, we'll get the December data come through. But it's obvious there, the Sydney and was, New South Wales as well, and parts of regional Victoria, but it was mainly the big cities that were hit by those lockdowns there. And we went back into a dip of negative 1.9%. But the fears are like a double dip. So a double dip is when you get a recession, 2 quarters negative growth, and then you rise and then you dip back into another recession. I don't think it'll happen because of the spending bounce and employment bounce was quite large in December. So we would expect quite a big growth in that December quarter there. The contributions to growth, similar to the year before, but the largest contribution growth is through government spending. And obviously long term, that's not what you'd want. You'd want more private sector driving economic growth, and so government contributed just over half, 1.9%, but it was even more than that when you consider that non-mining investment was the strongest contributor, but I've estimated about 0.2% of that was due to asset write-off incentives. So I know there's big incentives there for to write off. People went out buying machinery and equipment and new utes and everything, and were writing them off. Dwelling investment was also strong, but home builder drove a lot of that. There was a massive, substantial increase in renovations across Australia. And I think we touched on that last year, that rise in household savings. So, if you're lucky enough to have a good job that will continue throughout the pandemic, you didn't have much to spend it on in terms of services and overseas holidays. So the household savings ratio went through the roof, and people then started to funnel some of that into their houses, which was incentivised by government. So if you look on an annual basis here, if we compare September to September, these things change around so much during this period of time. But the two states that on top were Northern Territory and Tasmania. Northern Territory had very strong growth, but it's actually still below the peak that was in 2018. So they haven't. Northern Territory had a big expansion due to their big gas project up there. When that closed, then the economy collapsed, basically, or not collapsed, but it depressed quite a bit leading into COVID. And so they've recovered from COVID, but they're not back to what they were 4 years ago. Whereas Tasmania has been booming. Okay, so Tasmania housing is substantial increase there. A huge rise in machine equipment investment in the last quarter, that September quarter there, which is interesting. Most of the other states got their increase in that machinery equipment investment in the quarters before that, when there was all those incentives. But Tasmania's came later. I haven't dug too much into that. It might have been flow into the need for their dwelling and their construction. Victoria had the third largest growth if you look at September to September, but that, remember, last September was our massive lockdown where we dropped by 7.2%. So if you're comparing, our recent lockdown wasn't as restrictive. We made jokes about New South Wales being a mockdown, but if you look at kind of mobility data and economic spending, Victoria's lockdown was nowhere near as restrictive as New South Wales, and compared to the year before, it wasn't half as bad. If you look at New South Wales, well, last September they were doing all right. That's not showing there, but yeah, it's not showing anyway. But they had a big drop in their economic growth in September this year. Unemployment rate, the government will be spruiking this for as long as they can at historically low levels, around 4%. We thought it couldn't get much below 5%, but it's dropped to 4%. They keep rewriting what they think the natural rate of unemployment is. But we're seeing, this period here of those lockdowns, the labour force dipped back down to about 13.5 million, and the number employed fell right down to about 12.8 million. So we dropped away again. However, look at this rebound here in November, December. And it's estimated now that our labour force is the highest it's been. And employment is back to what it was in pre-COVID, basically, or above what it was in pre-COVID levels. So that that's a success story that the government can talk about. However, we know unemployment hides a lot of things. As I said, there's a lot of charts in this, but over 1 million more Australian workers were working fewer hours during that lockdown period. So it's a question of hours, basically. So you can be employed. So what happened is, and we saw this during the other ones when we had that job keeper program, that people kept their employment connections. So, and businesses kept their employees, but they furloughed them and they're staying at home and they weren't working hours. So, so they were employed. However, there was 1 million more than normal Australians who were working way less hours, and substantially number who were working 0 hours during that period of time. Then the lockdowns finished, and what we saw was in October and November, over 100 to, I think it was about 100 in October, or maybe in the 200,000 here or something, extra people took leave, which is understandable. The regions opened up and they said, oh, well, bugger this, I've been in my house too long, I'm going out and for a holiday. So they were still employed, but they weren't working during that period of time as well. So the unemployment, it hides a few things when you just look at the rate. The other thing I want to touch on here, this has a lot of stuff in it too. But the green bars here, is our increase or our change in working age population by quarter. And prior to the COVID impact starting to hit, and we stopped people coming in the country, we were averaging around 90,000 extra working age population being added every quarter, which is quite substantial, but we know our immigration rates were huge during that. And then it went to a trickle, because we didn't have people left, went overseas, and we had less people coming in, especially in Victoria. And so you only had an increase of 23,000 there. You had a decrease of working age population, slight increase. So it was hardly growing. Now, if you kept that rate as what it was pre-COVID, we would have an extra about 550,000 people in the labour force, either employed or looking for jobs. Now, we know if all those people are flooding in, then the unemployment rate obviously wouldn't be 4%, okay, because there wouldn't be enough jobs to go around. So that's how, that's a big thing as well. It's easy once you shut the gates and someone's got to do the jobs, so the unemployment rate drops and you start to get wage increases in supply shortage areas. The other thing is just look at the churn. I mean, amount of employees, 600,000 people lost their jobs. Then they bounced back to 100,000, and then another bounce back of 400,000, and then another loss of over 300,000 jobs here. And then, mass exodus of people in the labour force, actually around here. So it's been such a churn over the last 2 years, and it's quite an extraordinary period of time. You wouldn't have got this in history. So it's been a substantial challenge, as we know, for businesses and local councils, any employers. So let's have a look. Great resignation. So people wanted to have a look at this as well. And if you look at just the last rate, you go, wow, okay. 9.0, this is an ABS in their labour force survey. They asked people, do you expect to leave your job in the next 12 months? And 9.9% of people employed said, yes, I expect to leave, which is quite high when you look at the last kind of 5 years or so. But actually, if you go back longer than that, we actually had higher rates of people, over just 10.1% or equivalent rates of people back in 2014 who were looking to move their jobs as well. We didn't talk about the Great Resignation there. Yes, in America, there's a big talk of Great Resignation. Their economy is doing a few different things back there. But the other thing is understandable is, look at the rate when we had the big lockdowns, okay? It dropped to extraordinary low levels. So what's also understandably happened is people were put off changing jobs for a number of years as well. So they might have been thinking about a change job. COVID hit and they're like, well, there's no jobs out there, or it's probably not a good time to be looking for work at the moment. So they put off those plans for 2 years. Economy starts to improve, then those plans change. So, I mean, Great Resignation, as anything, big consulting firms will run on this and charge you heaps of money to do the analysis of it. And yes, if you're in, most of the people changing jobs are people who can afford to change jobs, either in high-skilled areas, and they're demanding greater flexibility, demanding greater wages and stuff. But there's a lot of people out there who are just looking for extra hours. And that's the main thing why they're looking to change their job, is to get something that'll give them extra hours. What about inflation? Yes, we had a massive, anyone who's been in the petrol station will know this has been, it's gone up quite a bit. So it's 30% rise there, which is huge. Holiday prices have gone up, which is a combination of less routes and demand increasing, and fuel costs as well. To buy a motor vehicle is a lot more expensive than what it was, and that's some of those supply shipping costs that have played through. Beef has gone up as well. There's a combination of demand and also agricultural farmers doing some restocking. New dwellings, housing prices have gone up as well. So inflation is rise to 3.5%, but there's a combination of supply side and demand side. What's there? The place that has most gone up is Hobart. No surprises there because the economy has been booming, but the housing costs have been through the roof, and because they're an island as well, their fuel costs will always be more expensive. Dwelling commencements, we saw that massive growth spurred on by the home builder program, and then it's dropped away in the last couple of quarters there. But what we also saw is the lag. There's always a slight lag between dwellings commenced, although they started to match each other for a period of time here, and dwellings approved. However, what we saw here is typically there's a 1 quarter lag. Now we have got a substantial 60,000 dwelling approved, 62,000 dwellings approved. We saw a big commence here. We would have expected commencements for the September quarter to be, around about here, are much higher, but they fell away a lot quicker. And that's probably some of those supply constraints for construction materials and labour shortages coming through there to causing a few delays. I might have to speed this up here. Population-wise, Victoria, if you just look at June to June, you'd go, wow, look at that. You know, we've gone from top of the pops. So our population growth was extraordinary over the last decade. As I said there, we had the largest population in numbers term, 35 out of the 40 quarters prior to COVID. Way higher than New South Wales, and that was when we were going to overtake Sydney. We probably still will, but who knows. But in the last year, we had a massive fall. Now, most of this is to do with overseas migration. And most of that is because people could get out of Melbourne, but they couldn't get into Melbourne. So if you look at this, is net overseas migration. Now, there's a lot of people, we had similar amounts of people leaving as New South Wales, but we had less people coming back because they couldn't get in. And same with interstate migration. We had similar amounts in New South Wales of people leaving, but people couldn't get into the state because of the lockdown. So the data is a bit distorted, but people will run on this that everyone's leaving Victoria and everything like that. But actually, there's more a case people couldn't get back into Victoria. Confidence levels, look at that. They were sky high actually throughout 2021, pumped up by government support and different things and vaccination rates. But then lockdowns hit, they dropped away, we bounced back again, and then we started the year with a big drop off in confidence levels. Everyone said, "Oh, not again," as Omicron came into the economy. But I feel, working from office restrictions or recommendations are removed next week, mask restrictions are removed and stuff. I think there'll be a bounce back in confidence in the next month. Okay, let's look at Victoria. Another bumpy year here. This is household consumption as it went along, and it bounced around. Lockdowns here, everyone stopped spending on recreation and culture. We came out in March and we're actually spending more on recreation and culture in March last year than we were doing pre-COVID. So people just went and splurged for a bit and then it fell away. And similar with a lot of things, they bounced back very strongly. So, people don't wait to spend their money once we came out of restrictions. They get out there and go gangbusters. The only thing, as we know, hasn't bounced back is transport. And this is not necessarily the vehicle costs here, and this is highly related to public transport costs as well. So we know more people are driving places and not using public transport. In terms of private investment, dwellings pretty much kept constant. We saw a flip, less apartments being built, but a move to housings being approved and spending on housings. Non-dwelling constructions dipped away, but a bounce back in non-dwelling, a huge increase of what are we looking at? At least $1 billion increase there of non-dwelling construction in that last quarter. And machinery and equipment, as we know, as I've said, was incentivised by federal government. In terms of building approvals, this is some of that non-dwelling construction I was talking about. Private sector non-dwelling building approvals were very high at the end of 2021, and it was also buoyed. Construction industry was buoyed by some major public sector investment here. The largest being the $1.5 billion Footscray Hospital, which is just up the road from where I live, and I see about, I think there's 12 to 15 cranes in the sky. It's a huge project there. Most places bounced back in terms of employment, so we had growth. So this is an index compared to pre-COVID levels, and we see most of them above where they were pre-COVID levels. Some of them much higher, so Wyndham 5%. But if there was no COVID, you'd expect these growth rates to be even higher than what they are. And a notable exception here is just out east here, so the Latrobe Valley and Western Gippsland, Wellington areas, Bass Coast areas, are actually still below pre-COVID levels. This data bounces around a bit because it's not seasonally adjusted. So I tried to take a period where the seasonal adjustments don't affect it as much. But this is reinforced actually by unemployment data as well. So some areas, some regions like Shepparton, which has those huge hospital and school construction projects and a few other ones, had a massive drop in their unemployment year to year. But the places that actually saw an increase in unemployment, so I've flipped this chart around because an increase is a worsening situation, but Latrobe, Bass Coast, East Gippsland, and I think we'll get Wellington here. So that backs up the jobs data here, that that particular region is travelling a bit poorly compared to other areas. According to Labour Force Survey, which sometimes is not as great, but it suggests a fall away in manufacturing construction industries, and in particular machinery operator and driver occupations in that area. Regional areas, is everyone moving to the regions? Well, there's definitely an uplift in housing approvals. So the largest growth in net, so we can 2021 to 2020, so the largest growth in number of houses was in Melton Bacchus Marsh, which is a metro, kind of outer metro area. However, number 2 was Geelong, and number 3 was Ballarat in terms of the uplift in numbers. And if we look at percentage changes, there's a lot of dark orange around the strait, big uplifts. So many places had increases of over 50% year on year in the number of their housing approvals here. So there's certainly a lot of people buying houses. Whether that's people buying second houses or moving, we're still waiting on that all important regional migration data, which was suspended. So they suspended the regional migration data, the ABS did, because they were using Medicare data for that. And then the problem happened. When people were needed to show their vaccination status, they had to go onto Medicare. And some people hadn't been on Medicare for years and years and years. And they went on Medicare and went, oh, I've got to change my address. And they changed their address. So suddenly thousands of people across Australia were changing the address, and the ABS suddenly couldn't use that data anymore because, they couldn't use it. Another thing looking at the differences between regions, which I might have touched on last year, is in trips. Google Mobility measures trips against a baseline. So this is City of Melbourne here. We see in December was still retail and recreation was still 30% below or 26% below what it was pre-COVID. Workplace trips still 30% below, and more people spending time at home, about 15%. But if you go out to Casey and some of the outer areas of Melbourne, retail and recreation trips were actually 20% above pre-COVID levels. Leading into Christmas. Workplace trips were only slightly below, 4% below what they were pre-COVID. And time at residence was, so you always get a spike around Christmas time because people on holiday, was only just 2.6% above. And some of this is to do with population. So this data is also not adjusted for population change during that 2-year period. And we know some of the outer growth areas would have added large amount of population, and the City of Melbourne may have lost some population in some areas as students went home. Looking forward, some questions remain. Big questions, tightening government purses. This is the Commonwealth and state government debt to GDP and debt to GSP ratios. Now, despite, Commonwealth, I always look at this graph because I find it hilarious. We know around this time here that the coalition got elected on a massive stop the debt campaign. And then after they got elected, they deleted all those advertisements and they increased debt over the next decade to historically high levels, even prior to pre-COVID. And then it started to flatten off a little bit, but then COVID saw massive increases once again as expenditure went up. But the biggest expenditure has been obviously in Victoria and New South Wales, substantial government support, state government support here. And we've gone from a rate around 4% up to 21, estimated around 21% over the next budget. And then that flows through to, so the survey by PwC early in the year, last year, 2/3 of local governments, executives, and probably some of your financial professionals, I think that local authorities will experience serious financial difficulties too. And I'm going to have to move this. And in 2021, we saw, it did differ by region, and we saw the main shires that are affected by their adjusted underlying results, so the ability to fund your long-term, your ongoing expenditure without looking at grants and stuff, with the smaller shires and the metro shires as well. So some of the growth areas did better, but some of the in the metro areas struggled. Interest rates, are they going to go up? The RBA has kept them constant at the moment because there's still a lot of uncertainty. So they know inflation is rising, but they don't know how far it's going to rise. And we know inflation has been driven not by just demand, but also supply factors. If inflation is heavily driven by supply factors, then there's not really an impetus to raise interest rates to weaken demand as much. But having said that, banks have already moved. So we know over the last 3 months, most of the major banks have increased their fixed interest rates. So they're moving before the RBA. But most people think the RBA will start to increase rates probably around mid-year. The question is if we come out of COVID and if Omicron gets under control and vaccination rates and we move to more an endemic stage and we open up the borders like we've just done now, will we go back to a big Australia? And we saw that most of the last decade, especially in Victoria, most of our economic growth has been driven by just opening the doors and letting people come in to our state. Australia, our growth is, we dig things up, we also grow stuff, agriculture. We don't really invest in innovation and compared to other countries, and we grow by accepting more people. Okay, so there was a poll of leading economists across Australia, and a large amount of them said, over a third said it's not enough. Let's get back to 190 and let's go even more than what we had pre-COVID. Some people said 190,000, yeah, it's just about right. So most people wanted really high levels. Only a small amount said, hey, hang on, I think this 160,000, which was floated around as a kind of a small immigration take, is a bit better. Now, there's pluses and minuses with both. Big economy means there's more access to skills. They'll fill all those shortages. It turbocharges economic growth. However, we know, and especially for Victoria, for a number of years, our GDP per capita, if you take that as a measure of wealth, was actually in decline. And no one talked about that. They just talked about GDP. No one wants to talk about GDP per capita, but we're actually in decline. And we know more people means infrastructure burden increases substantially, and local governments will know all about that. Other question is around emissions and renewable energy. Do we have a target? Now, we had the COP26 of all the international governments, a lot of pledges once again, but pledges don't necessarily mean actions there. But if those pledges if they translate to actions, we would see a rise to only 1.8 degrees. I think by 2050, I think it was, or whatever it was, we want 1.5%, I think it is, or something, or below that. So even the pledges and targets won't get it there. Now, our current federal government has floated some targets, but there's not much detail on how we're going to get there. But importantly, though, businesses and the community and other levels of government, especially local governments as well, are actually leading the way. So they're not waiting for the federal government. So we'll have a lot of carbon neutral targets set by local governments. There's some state or territory governments like the ACT are almost there as well. There's heavy investments in renewables. So we're getting there anyway. And the tide is turning. Most people are wanting towards this. So in summary, going forward, there's some upside potential and then downside risk. The upside, if we think rosy, COVID moves into endemic. We're able to relatively manage it with vaccines and new medicines for treatment. The stimulus wanes from governments, however, but it's met by all that savings that's been built up by households, and they drive it into consumption. Then we get immigration open out, more people coming in, it fills those skills gaps and drives consumption even more. And opening borders allows for greater transport movement and lowers the supply costs. However, on the downside, there's a potential for new variants. That's something that's more contagious than Omicron, or just as contagious, but also damaging a Delta. Inflation gets out of control, and so we have a tightening monetary policy that restricts expenditure and borrowing. Geopolitical tensions, who knows? Russia invades and things go crazy. China goes harder on Taiwan. The other thing is, there's uncertainty about China's growth as well. There's a real risk there that there's a downturn in their real estate market that translates across to reduced consumption. So there's a downside risk. The last little slide I'll touch on here, some considerations from local governments that are floating around. There's a lot of things I'm sure in your minds now. Long-term sustainability for finance professionals, I'm sure this is a big thing here. Big numbers of grants and targeted programs over the last couple of years. As federal state governments start to try and fix their budgets, they'll start to be drawn back. So even more so than ever, how do we maintain long-term financial sustainability? Big question that I'm sure you guys folks are tackling with. We saw a move to National Summit. So COAG finished, and we saw a move to the National Summit. There was the National Federation Reform Council with one representative from ALGA there, but there seemed to be a lesser role and a less voice for local governments at the table. How can we increase that voice going forward? What shape that might take if there's a change of government with the federal election? Leveraging and maintaining trust. Crises always tend to see a rise in trust in government in the short term, because people start to rely on government services and they start to think more about public sector than the private sector. So there has been an increase in government, especially local government as well, because local governments have done very well in supporting their communities. How can we use this trust and maintain it? And the main way to maintain it, most people say, is that communication and engagement. Local governments are transitioning how they deliver services and the type of services they deliver, and we need to communicate this. Managing housing affordability. Regions have seen a huge rise in housing prices and also rental as well. Now, you've got long-term residents who have been renting for a long period of time. Rental costs are going up. And we saw this prior to COVID in places like Byron and coastal areas. Now there's places who haven't experienced in the past who are going to face these challenges. And also, if a lot of people are moving to the regions, new residents, be careful what you wish for, new residents have new demands as well. What I've seen and what our company has seen in the last couple of years is an increasing role local governments are getting in economic development. We saw a lot of these buy local campaigns and supporting local businesses. But I've seen more and more councils start to think about what is our role in supporting businesses. You know, if you go 10, 20 years ago, there's a less emphasis. It was all about state governments and federal governments, how they could support businesses as well. But we're seeing a great emphasis. And the last thing here is we're seeing a lot of this talk about circular economy initiatives. On two parts of local government. One is because a lot of local governments control the waste facilities, and they're looking at ways, and there's restrictions on sending recycling overseas and all that sort of. So they're looking at how can we, you know, take advantage of these waste facilities. But other thing is, how can we support local businesses getting into the space? They're trying to generate job opportunities from circular economy. Okay, so in summary, Australia and Victoria, another year of substantial fluctuations. But the recovery is in sight, I think. But there is potential other variants. There's inflation is a risk as well, and there's a lot of geopolitical tensions, as there has been for the last probably 5 to 10 years. Our recovery is in sight. But it depends on what state, or country, or region you live in. So varies right across the country. No, WA is completely different. I mean, their state government has benefited from massive amount of royalties, but they're going to open up now. What is that going to, how are they going to adjust to living with COVID? But Australia and Victoria, a lot of this talk about big country here, seems to me that a lot of the talk is that we're going to return to what we did pre-COVID and just go, okay, let's open the borders, get high immigration. That's how we'll grow the economy going forward, just get more people. But we know that's not sustainable. You're just delaying it. It deals with some of the issues around an ageing population in the short term, but in the longer term, it creates just more problems. For local governments, financial sustainability, as we said, is a big pressure point, and we need to get long-term solutions in collaboration with other tiers of government. As I said, trust in service provision and community support in local governments is very high, and now's the time to leverage that trust and implement new services with good communication. And as I said, their local governments are taking a much stronger role in a number of other areas than they were probably about 2 decades ago. But where's their voice on the national level? You know, we need to get local government's voice at a national level much stronger, or maintain it to what it is. And I'll leave it at that. They're the final words. I went over time, but there's about 20 minutes for questions now.
Thanks, Keenan, and thanks for a very insightful and relevant presentation, I think, for all of us to take away. I think it'd be hard to not find anyone that would have said they weren't engaged throughout the whole presentation, and the fact that it's so relevant to some of the conversations that I'm sure we're all having within our organisations at the moment. So thanks, Keenan. I guess, as Keenan suggested, Keenan's left us plenty of time for some questions. So if anyone had any questions, you're welcome to put your camera on and ask the question, or put it through the chat. I see some comments there, Keenan. Just saying thanks for the presentation coming through. So well done.
Tony, I've got a question.
Go ahead, Danny.
Yeah, thanks, Keenan. Great presentation. Look, I was particularly interested in the one where you said that I think the figure was over 20%, where the state government had increased their percentage of expenditure over GDP. Is that mostly about dealing with COVID issues and putting on extra staff and the testing and things? Or is that also a reflection that people have stopped spending, even though we've got high employment? People weren't spending, so therefore the percentages changed? Or has it generally been that the state government has spent too much?
Yeah. So that was the debt to GDP, which obviously is a reflection of spending over deficits, basically. You have seen substantial increases in public administration servicing expenses. So all these things, like some will go out through contracts, check-in services, health services, all these things have increases basically. So there's a combination. And then this year, in the last year, because federal government had withdrawn back their JobKeeper funds, then the state governments in New South Wales and Victoria had to step in basically. And whether they should have stepped in or not, but there was a community expectation and a business expectation that someone has to support us. If you're going to have restrictions, you're going to lockdown again, someone has to support it. If the federal government's not going to return their JobKeeper to the levels it was before, then state governments felt they had to enter it. So if recovery occurs, then you assume some of that spending would be withdrawn. And then it'd be more about small spending around the edges to incentivise consumers to go out and spend. So money to get them to spend, like those kind of regional vouchers and CBD vouchers for spending that they had before, that in hand to hand with some of the local governments. It would be incentivise people to go and spend money rather than spending that was going to businesses to maintain their operations during that period of time. I think yes, people were spending less, but they were spending, actually consumption online was going through the roof. So, but that we know that online spending doesn't necessarily stay within the state. It goes interstate and overseas, all that money as well. But I think a lot of the increase in spending from state governments was extra, as you're right, extra services and in the healthcare sector, and also to running some of those, checking and auditing of facilities to make sure they were keeping COVID safe protocols, but then business support because the federal government wasn't coming through this year as opposed to last year.
Okay, thanks, Keenan. I had a sort of a comment or question, I guess, as well, while we're waiting for any others that might come through. It was good that you touched on the whole Great Resignation component, and there has been a lot of talk around that and comparing that to the 2014 figures. But I guess probably a bit of left field in the local government sector. We've probably been playing catch up in terms of other organisations in terms of what flexible working looks like and working from home. And now that we've all been forced at one point into it, do you see that as, what do you see as the key drivers in driving up that resignation element in the local government sector? And is that sort of some of the trade-offs that people are looking for when they're looking to work elsewhere, maybe?
Yeah, absolutely. I think, especially in the states, who's like New South Wales and Victoria, have had extended periods of lockdown, and people have been working remotely and everything. There's a genuine perception that for white-collar jobs and everything, that the return to normal won't be accepted. And people are looking for greater flexibility. So they're happy to go in the office. They just want to go back 2 to 3 days a week. And if their company doesn't provide that, they are looking for other options. So the Great Resignation, as people said, is it depends on what industry you got in. And if you're in a professional white-collar based industry and you've got the ability to shop around and find companies that are providing that flexibility, then you will be willing to jump ship as well, or you'll be willing to jump between the private sector and the public sector, whoever's offering those. We have seen, there was a general trend anyway in the last few years of great flexibility. I know state governments and other companies have been offering more paternity leaves and maternity leaves and these sort of things. So the weight moving back to the bargaining power for employees has shifted. And then once we saw restrictions on international people coming in, and we started to see these labour shortages, then the ability to negotiate your wage and your flexibility increase. Now, the challenge will be if we open up the floodgates and we allow for a lot of skilled migration to come back into the country, and so those labour shortages aren't there anymore, and we get a lot of skilled migration come in, people want to move to Australia just to enjoy our great lifestyle, will we have that bargaining power that we've had over the last year and stuff, or we may maintain? Will we have that bargaining power? Some of it will remain, but as I said, one big driver of the slowly increasing is also that just people put off their plans for a number of years. And I know even in our company, no one really left our company for a period of a year or two. And then the last few months, when things have started to open up, we've had a few people change jobs and we're starting to hire and everything. And talking to those people, it's because, just there's more jobs out there now, and there's more positions and flexibility, but also their plans that they put off for a number of years have changed.
That's great. Thanks, Keenan. We have had another comment of thanks, but also a question in the chat from Aidan saying, is the Reserve Bank likely to consider negative interest rates if any other shocks to recovery in general?
Yeah, it's a good question. So as opposed to some of the other jurisdictions like Japan and US and everything, our RBA has been very conservative and doesn't want to go to negative interest rates. And as often in the past, a lot of misstatements doesn't feel they're necessary for our economy. And I don't think we get I could be wrong, but the shock that we've had over the last 2 years is probably one of the biggest shocks, and it'd be unlikely that we get a substantial shock that will compete with the current one. There are questions. People say we could go into another financial recession. But prior to this, every 10 years or so, 8 to 10 years, we used to get kind of a downturn anyway, an economic recession, and we were due for one. The GFC was in 2008, but kind of stretched out longer. So there's a potential for another one, especially because we're heavily indebted in Australia and some other countries overseas. But the RBA in the past has also been very, very strong about the inflation being the main thing they choose to decide on their interest rates. And we've seen that rise to 3.5%. They're 3.5%. Their rate is 2 to 3%. They like to keep it within that band. So we'd have to get a pretty big shock, considering that prices have been tracking upwards, in order to bring those prices down and inflation down to a level where they'll consider reducing interest rates again. So it's very unlikely in the short term, but who knows within maybe 2 to 3 years' time if we've got another shock. But I think, I don't know, but unlikely. Based on past history, the RBA said they don't like to go to negative inflation. And also in our country, the banks seem to move sometimes before the RBA. So they start to adjust their own financial positions before the RBA, and that's in the past is also why the RBA hasn't seen it necessary to reduce the cash rate so much, because our banks have been a bit stronger in making their prudential financial decisions, unlike some other countries.
All right. Well, thanks, Keenan, for that comprehensive response. I guess if there are no other questions, just like to thank you again for me personally, a very relatable and useful presentation that I'll be taking back, and I'm sure that's echoed across a number of our members on screen today. So just like to thank you on behalf of FinPro, and hopefully see you again next time. Excellent.
Thanks a lot, and good luck with the year ahead and managing your budgets and everything. And as I've mentioned before, if you ever need any economic data or demographics data, just a little plug, our new data for local councils to subscribe to our Economy ID for the up to 2021 just went online this week. So get on board and have a look at the new data. And everyone's eagerly awaiting the census results. The demographic data comes out mid-year, and the economic data comes out at the end of the year, and we'll be updating all our profiles with that information. Okay, so thanks a lot.
Appreciate it. Okay, and with that, we'll move to a break. So we've got a little bit longer than initially planned. So if everyone can be back on at 11:05 sharp for Martin Thompson and his discussion on intangible assets, everyone can stay online here. You can turn your cameras off and mute, and then be ready for 11:05. Thank you.